I'm Tom Heavey. My goal is to educate you on blockchain and finance. My guest today is Kerman Kohli, a thought leader in the decentralized finance sector. He's joining us today to explain DeFi. We'll begin by giving a high-level overview of DeFi, discussing what it is and why it is important for our industry. We'll then move on to discuss the top projects in the sector: Maker, Synthetics, Compound, and Uniswap. So if you've heard of DeFi, or any of these projects, this is your opportunity to learn about them in a simple way. This is not a sponsored interview. Sponsored content has always been and will always be clearly disclosed on this channel. This is simply an opportunity to learn about one of the most exciting sectors in our industry. With all of that said, Kerman, welcome to the channel.
Thanks, Tom.
It's a
Great
pleasure
to
to have
be
you
here.
on. Yeah, tell me more about you. What makes you tick and what's been your story so far in this crazy industry?
Yeah, so for me, I was technical at a fairly young age. I made an app which managed to get a couple of million downloads and had about 100,000 people using it every month, and sold that off when I was 20. From there, I worked at a few venture-funded startups. So like just traditional tech where you see like a team grow from like 10 to 150 people, raising like tens of million dollars at the same time, and all the engineering challenges, product challenges, and operational challenges when you kind of like go from nothing to something. From there, I did my own DeFi startup for about 1.5 years. It was actually one of the first DeFi startups at the time, back when DeFi was even a term. So that was really fun. Had a team, raised some money. Unfortunately, it didn't really work out. So after that, started working at Mutable, the creators behind Gods Unchained, and also been writing a newsletter called DeFi Weekly, where I summarize what's going on in the space, giving breakdowns of like really complex things. And here I am today, explaining DeFi.
It's been quite a journey then. So let's
Indeed.
kick it off with the most high level basic description of, if you could break down what DeFi is in simple terms, decentralized finance, what would you say it is?
Sure. Decentralized finance, I would really just say, is global finance. The term decentralizing can be very misleading in its definition. So, in the way that we say that each country has its own financial system, DeFi is a financial system for literally the entire world, which works on the internet and doesn't require any paperwork or cares about who you are. As long as you have the money in a crypto form, you can deposit it and get access to all of these banking services such as lending, borrowing, uh, margin trading, exchanging. Yeah,
I think you've kind of touched on it there, but would you like to elaborate why you think decentralized finance is so important? And not just for us in the developed world, but others globally as well.
sure. So traditionally, finance is a very gated industry, but also has a lot of significance, right? In order for you to get a home that you want, whether it's a mortgage or being able to get money for a new business you're trying to launch, there's always an element of finance. And finance is about uh, risk, about for today in return for something else tomorrow. There's always like a transaction where you need a counterparty. And uh, there's no reason why we shouldn't be able to do that with anyone, anywhere. But in the existing financial world, it's limited by the country you're in, who you are, and quite often your history as well. So this is kind of like a new playing field for, if we had to remake finance, how would we do it with no government control, which has its advantages and disadvantages, which we'll kind of see as time goes along.
So let's move on to talk about Maker. Some would argue Maker and its stablecoin DAI, they underpin the entire DeFi sector in a way. So I believe it's only right, as we begin to discuss these specific projects, that we kick it off with them. Can you break down what Maker is, and maybe more on a high level, not necessarily going that much into detail on how it works in this video, but just explaining what it is and its importance within the DeFi sector?
Sure. So MakerDAO, think of it as the central bank for Ethereum, where the asset you use as collateral is Ether, and you get a loan in US dollars. where the loan is denominated in a currency called DAI, which is equal to $1. And what this allows you to do is create a decentralized stablecoin, which is fully backed by Ether and not based on the trust of a third-party institution.
Yeah, and why do you think it's so important for the DeFi sector to have this?
Sure. So the importance of having a stable coin means that we can represent value in dollar terms, which is how we think about the real world, rather than measuring it in ether, which is very volatile, um, and it is a lot hard to mentally think about, right? If I say I'm giving you a loan for 0.005 ETH, and in return you'll give me 0.07 ETH as interest, or that's very unintuitive to think about, but also from a code level, it doesn't make for the cleanest application. So by having a stable coin, we can now account for everything in dollars, but simply talk about Ether as a transaction cost for using the network.
Yeah, I mean, like you say, the ability to have things denominated in dollars. I think generally for people in the outside world, this applies and makes so much more sense to them. The volatility
Uh,
of Ether and Bitcoin and every other cryptocurrency, it's just crazy. Let's move on to synthetics, because they're the biggest, they're the second largest DeFi project, based at
yeah,
least on the value of Ether locked up. So
yeah.
can you break down again from a high level what they are and why they're important for the sector?
Sure. So we kind of touched on like this whole notion of bringing US dollars to Ethereum, where you can have a central party that mints a digital dollar and says, we promise we have $1 in the bank. And you have MakerDAO, which is known as a synthetic asset because uh, one DAI is backed by something else. Like you have an asset that creates representation of another asset. So synthetics is, as the name implies, a protocol which allows you to use the SNX token to mint a whole new other asset. So you can use SNX to generate euros, gold, stocks, really anything which has a price feed on the blockchain. You can use SNX tokens to create a representation of that. And what that allows you to do is, once again, like MakerDAO, bring an asset which you usually couldn't bring over very easily, but now you can because you just need SNX token. So I could own S gold or S Australian dollars or S pounds as long as I hold some SNX and I convert it over. So that's a really powerful tool because then you can start lending gold on the blockchain without having to get a central party to bring a real bar of gold, lock it in their vault, and mint a token.
Yeah, like you said, it's a really powerful use case. And building, I would imagine, a lot of traditional finance things into DeFi. So, like you say, the lending elements there, you can have an interest rate, you can have APRs, you can actually build some of the stuff which is on traditional finance. And that's good, is the key thing I would say. Like, not all, I think some people take the stance that we don't want to rebuild anything in traditional finance. I would argue that most of it has been built in a way which is kind of smart for a reason. It's not like traditional finance is so stupid that they decided to add things like lending and borrowing, which don't make sense. Of course, these things make sense, and we want to see them because that's really how you go from where we are to where this industry could be in the future.
Absolutely.
Is there anything you'd like to add about synthetics?
Yeah, I think Synthetics is an interesting project in the fact that they did a 2017 ICO, which was really large. It then lost 90% of value, but then the team kept working hard and delivered a product of value, and it's reflected in the token price and the traction they've got. But I think Synthetics is important in the DeFi community because it's kind of shown that you could have invested in the equivalent of like Goldman Sachs or one of these financial firms, but really is a protocol on the blockchain that's delivering value for people.
Yeah, it's actually been crazy to look back. I remember I actually reviewed them back when they first had their ICO, and I think they were at Haven
Yeah.
delivering a stable coin. And then I just looked at the graph the other day, kind of painful in a way, watching it rise and not being a part of it. But they went from like 3 cents. And the craziest thing was the trading volume. One day I saw was $251. And if you just like looked at the chart from the ICO to that point, you would have guaranteed written them off. They're clearly just one of these projects which they might be building, maybe not, but they're certainly not getting traction. No one's really looking at them, and no one's interested in their token. And then, like you say, the ability to They've just carried on building behind the scenes and actually pivoted to something which I would argue is more valuable than a stable coin, because I think we have quite a few of those. We don't have many synthetic platforms. And they're also building some cool things in traditional finance. Like I've heard that they're trying to introduce the ability to trade stocks, but they also find price discovery with stocks by allowing trading over the course of the weekends, which obviously stock markets traditionally don't allow. Do you have any thoughts on that?
Yeah, and I think that's kind of like, if DeFi is currently bringing finance 1.0, we're now starting to enter the phase of like, how do we create finance 2.0 with these basic primitives, but then all this really cool technology that we've got. And I think, for example, like having allowing you to trade stocks after hours without it being coupled to the official price, that's like a whoa, like we're kind of getting into some really interesting territory here.
Yeah, I can't wait to see that come about, because you have stock markets that close. And I remember growing up and thinking that that just seemed wrong. Like you hear all these bankers and traders that work so hard, and then I learned that their hours are like the same hour. I guess they obviously work outside, but the hours of the stock market are the same hours of like traditional banks or something like that. And it didn't sit with me. It didn't like logically make sense. And then you have these crazy events that happen over the course of a weekend, usually Elon Musk tweeting something. And then Monday, the valuation just crashes or it spikes in a company. And there's obviously over the course of the weekend, all these people who want to place a trade, they want to either get out or get in, but you don't have price discovery. And the ability for synthetics to allow price discovery so that we know roughly where the price of a stock could be on a Monday, that's extremely powerful. Like you say, not just for DeFi, but really touching on traditional finance.
Indeed, yeah, and that's where we kind of talk about like finance is the first use case of blockchains, and people are slowly waking up to that fact. It'll just become evident in the next bull run to everyone else.
Yeah,
No
like even
problem.
as you say, it just a tool in a way it could be for traditional finance. If synthetics, for example, or any project building something similar, was able to build enough liquidity to see stocks being traded over the course of the weekend, it's like a prediction market for real traders. And obviously, to begin with, it's going to be a fraction, a tiny little fraction of the kind of trading volume you'd have for these stocks in the real world on stock markets. So maybe the price
Mm,
discovery won't be great to begin with. But if you can build it and you can introduce liquidity, there's actually a real use case for actually being able to understand where the price could go on a Monday morning.
exactly, and I think it's really powerful in the fact that for everyone outside of the US, accessing US stocks is a pain. Like you got to sign up for a brokerage, give up a bunch of paperwork. The trading fees are really high. The timings are inconvenient. It's actually a problem, right? So when you say you can do this instantly with very little capital, cheaply, and you just need some stable coins or ether, and you're good to go. That is actually a 10x improvement, right? And in technology, when something's a 10x improvement, that's when you hit the jackpot.
Let's touch
Mm,
on Uniswap, because, from my memory at least, and I may be wrong, but they're one of the oldest DeFi projects around. And I think they play a pivotal role within the functions that they carry out for the market. So, again, from a high level view, could you sort of break down what Uniswap is, what its role within the DeFi sector is, and why that role is so important?
sure. So I'm going to give you a very simple explanation, but I'll allow you to dig deeper if necessary. But uh, Uniswap primarily is a way to enable new markets to be formed without requiring an expensive market maker, which you usually need. So that means if I have a token that represents myself, I have a token that represents a stock, I'm a new um, ICO on the market or like project and I have a token to bootstrap liquidity for those markets because there's not a lot of money involved is really, really difficult. And more often than not, you can't actually get a market with them. What Uniswap did through some clever math and technology actually makes that entire process of creating a new market very, very easy from a technological point of view, but also making sure the math adds up. And what that's really meant is that now any token which holds value can suddenly have a market and a price ascribable to it um, instantly, cheaply, and from anywhere in the world.
I mean, when you just say those words, it's obvious how huge that is. And correct me if I'm wrong, I think the way that it works is, like you say, you take away the need to trade with another human. So if you have a token which is maybe new to the market and maybe people aren't as familiar with it, it might be more difficult to match a buyer and a seller. So what you have instead is like a pool of people who are willing to commit their tokens, and in return, I think they receive an interest rate. There's like that incentive for them to commit their tokens. And then that means other people can essentially trade with the pool. So in a way, they're not having to match a buyer and a seller, but they have this liquidity which is guaranteed.
Yeah, we call it person to contract trading rather than person to person. What we typically find with blockchain is finding one user and matching them with another is really difficult and often doesn't really work that well. But as soon as you say you just go to the smart contract and the smart contract will always have a price for you, it will always have tokens to give you. That's a really powerful model. And yeah, what you described is kind of accurate that everything revolves around the smart contract. So you're a buyer to the smart contract, you're a seller to the smart contract, or you're a liquidity provider who's providing both tokens and actually bootstrapping that market and allowing the price to be set by the contract. You just earn interest as trades are being made.
The first question that kind of comes to mind, and I know it's sort of a technical answer, um, but I think people might be thinking that is, if you're not trading with an individual, then it's more difficult to understand how you get to a price. So how has that roughly worked out?
So keeping this as simple as possible, the way Uniswap works is simply by determining the price by a ratio of two tokens. So at a very high level, if I have $100 and one ETH, and one ETH is equal to $100, they're all the same. That means that the price of ETH, I can say $100 divided by 1 equals to 100. Now, if the price changes somewhere else on another exchange, arbitrages will actually manipulate the ratio of these two assets to set the correct price and make a profit. So the pool is basically just a ratio of two tokens that match the external world, and that's how the price is really set. As in, it's not explicitly set; it kind of trails the market very closely.
So arbitrage, like you say, is a key factor there. Because if the price was wrong, then, or wrong, whatever you want to define it, it was different on a different exchange, let's say, then people would see an opportunity and they'd go and buy cheaper tokens and just go and sell them on that exchange, make a profit. So you have those incentives in a way to push the price to the same value that's being traded on other exchanges.
Indeed. So it's really just a ratio between the tokens, and you rely on the incentive of other people wanting to make money to keep the price correct, which is a very powerful incentive, as we all know.
Yeah, and it's worked very well so far. It's being built up over the past few years, and it's interesting. It doesn't actually have, I believe, a native token. It's described as like a public good.
That will change soon.
Interesting. Do you think?
Yeah, it's every Silicon Valley startup you see that has some kind of DeFi product will have a token. It's just a matter of when, not if. Because the realization is that if you think about traditional company stock, you need to get it to an IPO for it to actually be worth anything. And if you look at even Coinbase, which is arguably the most successful crypto company that's been around for like 8 to 10 years, still isn't public. So in order for investors to kind of get a return on their investment and be able to sell it to someone else, a token is the only way to do that without going for a 5 to 10 year timeline where the technology completely changes or if it's even viable.
That's really interesting. How do you think it will be possible to go from a system with no token to putting a token in there?
So I'm going to be careful about how much I can share here because, uh, yeah, but traditionally, not traditionally, typically what we're starting to see a trend towards is you get the cap table of the company prior to a fundraising round, and you make an agreement with investors to say that the cap table will mirror the token holder kind of distribution, but with the difference that 50% of the tokens will go to the future users of the protocol to incentivize usage. So we're basically getting that same equity cap table, putting it on the blockchain, making it decentralized, and you're good to go. So it's kind of like the whole idea around an STO, but not really, because you're creating a decentralized protocol, therefore it isn't a security. At least it's not supposed to be.
That's really interesting. How do you see that playing out from a user reaction perspective?
Well, we're seeing the fight between the West and the East now. So in DeFi, for every project, you will find a counterpart which has a token and one which has an equity component and will transition to become a token. So you've got Compound, which is your Silicon Valley equity startup, which now is releasing Comp. And then you have Aave, who's got Lend from day one because they did an ICO. And to see how these tokens will compete against them, what these teams can do, are going to be very, very different and fascinating to play out because structurally, these two teams are different. The one based in the US that has shareholders has to move slower, has to be more prudent, has to have better risk management, whereas the token ones actually can use a form of regulatory arbitrage to be more aggressive with what they offer, but also get users excited because their token's available on exchange. There's no very large VCs holding onto the distribution, which actually makes quite a big difference in crypto because when you have a large VC that holds a big chunk of funds, they can dump on retail, as we saw in 2017. Of course, it's not to say these VCs will because they're much more sophisticated than the kinds we saw. But at the end of the day, they need to make a return and they need to sell their tokens to someone else at a higher price.
Well, that's going to be really interesting to see how that plays out. And it kind of touches nicely on the next topic that you actually just touched on there, which is Compound. So they're the third largest DeFi project, again, based on ETH locked away. They describe themselves as an algorithmic autonomous interest rate protocol built for developers to unlock a universe of open financial applications. And that's a mouthful. So can you break down kind of what this means and again, their importance within the DeFi ecosystem?
Yeah, crypto companies and their wording aren't always the easiest to understand. But I think if we use the mental model we described before, of rather than saying here's a lender and here's a borrower, but saying I'm a lender or a borrower and I go to the smart contract, that's kind of how you want to think about Compound. And in its simplest way, uh, it simply says how much money. So I'm a lender. I will deposit funds to this protocol, and it says there's $10 million being given to lenders, and then you have borrowers that come along that collectively borrow, say, 8 out of the $10 million. The pool is now being utilized 80%, and therefore that 80% maps onto an interest rate defined by a mathematical model, and that's how you determine the interest rate. If there are more lenders, the interest rate goes down. If there's more borrowers, the interest rate will go up. So it's really just a constant ratio between lenders versus borrowers to get this rate, which means as a result, I as a lender simply give it to the smart contract and I start earning interest straight away. I don't have to be matched with someone else.
So it's kind of like lending and borrowing that we see in traditional finance. And
Exactly.
this is probably kind of an obvious question, but why do you think that's important for DeFi?
Well, it's the biggest thing is that you can achieve yields that are typically higher than you see in the real world. So many places around the world are like sub 1% interest rates, or we're starting to even see negative interest rates. But on DeFi, you can actually get anywhere between 2% to 15%. It's variable and it changes, but it still beats traditional markets by a fair bit amount. So that's a really powerful innovation because really there's no bank, there's no central government, there's no brokerages that you're going through. It's just you and a smart contract.
So, like you say, it's taking out some of those middlemen. And instead of those middlemen who extract a ridiculous fee, like a truly ridiculous fee, you give money to a bank, they give you a tiny interest rate, they turn around, they lend that money to someone else, and they take a huge chunk of money off that person. And they never really give it back to anyone. They just keep this in a way of like oversimplified, of course. But if this is the difference between what the lender and borrower are getting, this is what the bank do. They keep all of this and they charge a ridiculous fee. So by taking them out of the equation, you can almost split it, take this whole pie and share it between the two people, the lenders and the borrowers.
That's exactly it. And I think in 2017, everyone talked about cutting out the middlemen, but nobody really knew what middleman is being taken out and why would it be good. But here's like another use case where you say like, here's why it's good, here's how it adds value, and here's why it could be really big.
It's been a great conversation. I've been blown away by your knowledge on DeFi, and I think viewers will be feeling the same way at this point. If they'd like to learn more about you, follow your journey, where would you recommend that they check out?
Sure. So I write a newsletter that breaks down a lot of events in DeFi in detail and helps you really get a sense of like what's going on beyond the headlines, and giving you a bit of like, I'd say, an insider's edge into the market. So I have that newsletter, defiweekly.substack.com, and I also post quite frequently on Twitter as well, about any important things. So yeah, follow me there if DeFi continues to interest you.
All right, Mano, we think we've touched on everything in quite a lot of detail without going too complex. And I'd love to have you back on again in the future to really break down some of these projects in more detail, not just to understand what they are and why they're important, but also to understand how they actually work. But I think for this conversation, for this first discussion, we've covered everything quite nice on a high level, and I don't want to take up any more of your time. So, Kerman, thank you for joining me and sharing your knowledge on DeFi.
No worries. Thanks a lot for having me, Tom. Really enjoyed this chat.